In today's video, I'm going to share with you a pattern that caught my eye recently. It's a repeating pattern inside of gold, and I was looking at gold futures when I stumbled across this. It's occurred 100% of the time over the past 5 years, 90% of the time when you look back 10 years, and almost 45% of the time when you look back 20 years. In today's video, we're going to break down not only what this pattern is, but how you can take advantage of it via day trades and swing trades. Now let's get started by coming into our Thinkorswim charts, and I have the seasonal analysis indicator loaded on. This is a free indicator available to everyone, and I'll leave a link to it in the description box below if you'd like to download it and follow along. Now, I'm on a chart of the gold futures on a daily time frame currently set to 5 years, and we'll soon expand this to 10 and 20 years as well. Now, inside of our seasonal analysis label for September, we can see two different numbers. The first number, 0%, tells us that over the past 5 years, September has had an up month exactly 0% of the time. Every single month over the past 5 years has been a red month, a down month, and on average, that move has been negative 3%. So we know over the past 5 years, we have a pretty strong bearish bias here. Now you might be wondering, well, that's only over 5 years. What happens if you give this more data? Let's go back 10 years. Over the past 10 years, you can still see similar numbers. 90% of the time, September is a down month. Only 10% of the time do we have an up month here. On average, that move is still good for the negative 3%, which tells us that September overall has had a bearish bias. Now, gold opened at 1966.4 this September, and if we project 3% from the downside, that gives us a price closer to the 1907-1908 range. And we're a bit of a ways away from there. So there's a lot of room to take advantage of this along the way down to 1907-1908 if we get there. And if, say, at any point over the course of this month, we do rally and get better opportunities above that 1966.4 mark, that also gives you an almost instant edge. Now, over the past 20 years, that's where this pattern starts to fade just a little bit. You can see here September goes up to having an up month 45% of the time. So still more frequently, we do have down months 55% of the time. But that average is also not the same negative 3%. Instead, it's just negative 0.26%. So the fact that it's negative still helps this bearish idea. However, the fact it's not negative 3% might give you a little bit of pause here. Might make you want to wait for a slightly better entry than that 1966.4, which is where we opened for this particular September. Now, a different way that you might be looking to try and take advantage of this move is by fading any intraday volatility edges that you get. This is where things like our scalper volatility box really come into play. We're looking at intraday rallies like this one and trying to take advantage of any bearish moves that we can see. Remember, we have the bearish bias, so you might be looking at bending some of the rules if there's a setup that's familiar and one that you can take advantage of. For example, this setup right here is our momentum reversal setup. I won't go too deep into that in today's video. I'll leave a link which breaks down that setup in more detail, but that's the overall idea for day traders. Find intraday rallies into key levels. For us, we're going to be using our volatility box zones and take advantage of those levels by fading to the short side. We have a short side bias here, so let's try and take advantage of that. For swing traders, you might be looking at something like a trend following strategy. So for example, if we come into our daily time frame, right now the market pulse has really not given us any kind of clarity. We can see the market pulse has hovered between green to gray to red over here, back to green right here, and currently we're just chopping around. If we start to gain the sense of direction, which it's looking like we might start to shift to the deceleration side, which would mean we start to see a red label here, then you can start to ride that trend for as far down as we can. We're looking for that first candle in which the market pulse goes red, and then looking to try and ride this trend, almost like you're surfing a wave of sorts. So that to me would be the swing trading strategy, is wait for the trend to switch inside of gold, and then try and ride it as far down to the targets that we talked about, that 1907-1908 range. All right, so one more time to recap. We started by taking a look at the seasonal pattern inside of gold. We looked at the 5 and 10-year periods, which had this overall negative bias, or the reasons why we had our bearish lens on in the first place, and we then used that bearish lens to identify ways to take advantage of this move, both via day trades and swing trades. We note 3% from where we opened gives us a price closer to that 1907, 1908 area, and if at any point we do break above where we opened for the month, that really, I think, gives you the most instant edge out of them all. Alright, take care everyone, good luck trading, and I'll see you in our next update.